Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is August 6th, 2025. I am Luna.
I am JPMorgan. You've got these resilient earnings, but then trade risks popping up, signs the economy might be cooling.
Exactly. So we'll look at the numbers, try to connect those dots, and figure out what it means for you, for the economy, and maybe where things are heading. Let's jump in.
Okay, so let's start with the market snapshot. Last 24 hours, U.S. stocks saw a modest pullback.
Yeah, the Dow, S&P 500, NASDAQ, all slipped a bit.
My read is that hints at some underlying caution, even with earnings season being generally pretty positive. What are you seeing?
You're right on that. What's fascinating here is even though about 80% of S&P 500 companies actually beat profit expectations.
Which is a strong number.
It is. But the market tone stayed cautious. We saw trade-sensitive sectors really underperform.
Oh, like who?
Well, take Yum. Brands, that's KFC's parent, they sank over 5% because of steep import duties. And Caterpillar warned about a potential $1.5 billion tariff costs this year.
Wow. So that really highlights how these trade worries are weighing on sentiment, doesn't it?
Clearly. No question about it.
Okay, so moving beyond stocks.
Right.
What about commodities? Bonds. Bitcoin eased a bit after those record highs. Oil bounced back. Gold held steady. These moves often hint at bigger trends. So what's the story in the bond market? That's where things get interesting, right?
Yeah, the 10-year U.S. Treasury yield, it ticked up slightly to about 4.22%. It really reflects this delicate balancing act for investors. On one side, you've got these tariff-driven inflation risks.
Right, tariffs pushing prices up.
But on the other hand, you have growing signs the economy might be cooling down. Actually, yields pulled back from bigger gains after some weaker services data came out, which kind of reinforces those slowdown signals.
Okay, speaking of slowdowns, two big macro things happened in the last 24 hours. First up, the U.S. trade deficit.
Yeah.
It hit a 2-year low. Now, on the surface, that sounds pretty good, right?
It does. It narrowed sharply by 16% down to $60.2 billion. That's the smallest gap in almost 2 years.
So what's driving that?
Largely a big drop in imports of consumer goods. And interestingly, the trade gap specifically with China, it plunged to its lowest in over 21 years.
Okay, so less importing. Good for the GDP number maybe, but what's the catch?
Well, while it can technically boost GDP figures because net exports improve, it absolutely reflects the bite of President Trump's tariffs. The average U.S. tariff rate is now 18.3%, highest since 1934.
Wow.
And yeah, the catch is, it probably signals softer consumer demand too, and definitely disrupted supply chains. Imports don't just drop like that without reason.
That makes sense. Fewer imports might mean people are buying less or companies are struggling to source things. Okay, and then the second big thing, the U.S. services sector, a huge part of our economy. The ISM non-manufacturing PMI. It's practically stalling out. What's going on there?
That's a really critical point. The PMI slipped to 50.1 in July. I mean, that's barely above the 50 mark that separates growth from contraction.
And that was a surprise.
A negative surprise for economists, yeah. Business activity was basically flat, new orders, not much change, and the jobs part, the employment sub-index, actually fell deeper into contraction.
Oof. Okay, so activity's slowing. But what about costs?
Ah, that's the kicker. Input prices for services, they rose at their fastest pace in nearly 3 years.
So activity stagnating, cost rising. That sounds uncomfortable.
It raises those stagflation concerns, definitely. That nasty mix of low growth and high inflation. It really makes policymakers sweat.
You mentioned trade tensions earlier. It's not just China anymore, is it? President Trump's now talking about India.
That's right. He threatened very substantially higher tariffs on imports from India.
And the reason?
Specifically cited India continuing to buy Russian oil. So this really expands the potential scope of these trade conflicts. It's another layer of risk beyond just the U.S. and China.
So is this just talk, like a negotiating tactic, or?
Well, that's what the market's trying to figure out. Is it a tactic? Or the start of another long tariff fight, especially with hints about tariffs maybe coming soon for pharmaceuticals and semiconductors.
Okay, so lots of moving parts. Cooling growth, these rising trade tensions, but also the potential for the Fed to maybe step in and ease things. Looking ahead, what are the key things we should be watching? Data points, policy signals, things that could really swing the markets.
Number one is the July U.S. Consumer Price Index, the CPI report. That's out next week. And it's pivotal. Wall Street's expecting core inflation to stay moderate, maybe around 3.0% year on year.
And if it is moderate?
A tame CPI would really reinforce the case for the Fed to cut rates in September. Markets are already pricing that in pretty heavily.
Okay, CPI next week. Anything else?
We're also watching the weekly jobless claims, just to keep a pulse on the labor market, and any news on President Trump's upcoming nominations for the Federal Reserve Board, maybe even for the next Fed chair. Those appointments could signal big shifts in future policy.
Right. So with all this complexity, this tug-of-war we mentioned, what's the overall takeaway for our listener? What's the market outlook?
I'd say the outlook is one of cautious optimism, but investors are definitely in a kind of pause mode right now. Equities are still near record highs. Earnings have held up surprisingly well, but that risk of stagflation, it's on the radar.
In the trade stuff.
Trade policy is still the biggest wild card. Any more escalation could really disrupt supply chains, weigh on global growth. So for you listening, it's really important to stay nimble, stay diversified, focus on quality. Yeah, the last day's news really just underscores this delicate balance, doesn't it? Cooling momentum, rising trade risks. But maybe policy help from the Fed is coming. Expect some choppy trading ahead.
It really shows how tangled everything is, global trade. Inflation here at home, what the Fed does, it's all connected. So given this complex dance between growth slowing down and prices maybe staying sticky, here's something to think about. What unexpected turns might we see next in global supply chains, and how could that ripple through into your everyday spending or even your investments?
Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver day's key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.